Hi everyone, and welcome back to The Independent Dollar, where we make informative and unbiased personal finance videos in a way that is straightforward and easy to understand. In today's video, we're going to be taking a closer look at GICs, how to build a laddered GIC portfolio, some common misconceptions with GICs, and how interest on guaranteed investment certificates is paid and then taxed. Now, for the purpose of today's video, we are going to assume that you're already familiar with what a GIC is. However, if you're new to guaranteed investment certificates, start by checking out our intro video on GICs to learn the basics first. While we often spend most of our time scouring the internet to find the best possible interest rates, we often forget that the rate of return is only part of the whole picture. To be effective, we suggest building a GIC portfolio with a specific strategy in mind. The most common way to do this successfully is to ladder your GICs. But what does laddering mean? Laddering your GICs means purchasing GICs strategically to allow a portion of your portfolio to mature on an annual basis. This will allow you the flexibility of having access to funds on an annual basis for convenience, but also takes advantage of rising interest rates. On top of that, it protects your portfolio from a decreasing rate environment by keeping a portion of your GICs invested in more favorable rates, while renewing only a percentage of your portfolio at a time. Let's take a look at an example. Let's assume you have $50,000 to invest. Now, typically, you would start by shopping around for the best rates and then investing your money into one GIC. However, investing the full $50,000 into one certificate leaves you open to the following risk. First of all, should you require a portion of the money for an unexpected emergency or critical purchase, you would be forced to cash in the entire GIC early, and that'll likely result in a forfeit of all interest earned up until that point. Second, if interest rates were to rise, you're unable to take advantage of these rising rates until your entire GIC matures. And finally, if rates were to fall, by the time your GIC matures, the entire portfolio will be renewing, all of it at the lower interest rate. Instead, you could consider structuring your $50,000 investment the following way. Instead of purchasing one GIC, you'll purchase 5 GICs instead, with the following laddered maturities. As each GIC matures, you'll renew them into a new 5-year term. Now, I know this might seem intimidating locking into a 5-year GIC, but keep in mind, each year 20% of your portfolio is going to be coming due. After 1 year, your portfolio will look as follows. As you can see, we've now reinvested that GIC that matured in 2021. And as each GIC comes due, you will continue to reinvest into a 5-year term. This is going to give you the benefit of a higher average rate of return on your entire portfolio, since longer GICs typically offer higher rates of return. And on top of that, it's going to give you the flexibility that purchasing a 1-year GIC typically offers, the ability to access money from your investments on an annual basis. 5 years has now passed after your initial investment, and your portfolio has completed the entire phase-in process. So your GIC portfolio is now operating as follows. 5 equally weighted GICs, each in 5-year terms, with one coming due on an annual basis. If you watched our video on market-linked GICs, we showed you the pros and cons of what those GICs have to offer. This would be an excellent strategy to implement with those types of GICs as well. It'll offer you the same flexibility to access your portfolio on an annual basis, while also reducing market risk by eliminating your entire portfolio from maturing on the exact same day. Aside from building a strategic GIC portfolio, here are the most common misconceptions when it comes to GICs that we think you should be aware of. If your GIC auto-renews, there is nothing that you can do. You're locked in until it matures again. This is actually not correct. Just because a GIC auto-renews, it doesn't mean that you're forced into keeping that GIC. There are guidelines in place to protect you from these situations. According to the Financial Consumer Agency of Canada, if your GIC automatically renews, you actually have the ability to cancel the renewal within 10 days of the new GIC being issued. The second misconception is joint accounts. If your GIC is joint, then you can decide who pays the tax. Unfortunately, this is not correct. With joint accounts, the interest cannot be split between the 2 account holders, unless they both contributed their own funds into the investment. Otherwise, the income must be taxed in the hands of the person that it originated from. If you watched our video this year on our tax tips, you would remember us mentioning attribution rules. In this example, you can't split the income or decide which spouse will claim it. It must be claimed by the person where the money originated from. The next misconception is that if you pass away, all interest on your GICs is lost. Typically, if you were to pass away, the GIC is cashed out and interest is paid up until the date of death. However, not all GICs are alike. With market-linked GICs, for example, interest is only paid when the GIC reaches maturity, and that's because the rate of return is based on the value of underlying securities on a specific date. In that case, should the owner of one of these GICs pass, then it is unlikely that any interest would be paid. Now, with joint accounts, typically should one owner pass away, the survivor can maintain the GIC either until maturity or is sometimes provided with the option of cashing it out early without penalty. So make sure you speak to your investment provider prior to purchasing so you understand what all of your options would actually be. They are required to provide you with this information, and they should be able to do so in writing. And finally, the most common misconception is that you didn't receive a tax slip, so you don't need to pay tax. When you're just starting out your investment journey, your nest egg will be small as you start to grow your savings. But if you don't earn $50 or more in interest, it is unlikely that a tax slip will be generated. But in that case, you are still required to declare that income on your tax return, even without the slip. Now let's take a look at the different ways that interest is paid on GICs and how it is taxed. One way that you can receive interest from your GICs is to get paid monthly, quarterly, or annually. In these cases, the interest is paid to you each year and not reinvested. At the end of the year, you'll receive a tax slip in the form of a T5. Any amount of interest reported on the T5 slip will be added to your taxable income for that year. Another way to be paid interest is for it to be reinvested, allowing any interest earned to compound within the GIC until it finally matures. So as an example, you had purchased a 5-year GIC, and at the end of each year, any interest earned would be reinvested and then paid to you at the end of the 5-year term. This allows you to earn even more money by earning interest on your interest. Here's an example of how that would look on the same $50,000 GIC. As you can see here, any interest is reinvested back into the GIC every year. However, one common misconception is that with compounding interest, you don't pay tax until the GIC matures, which in this example would be after the 5-year period. Unfortunately, this is not correct. With GICs, any interest earned within the year, even if it's not paid out to you and is instead reinvested, will be added to your taxable income for that year. Just like the previous example, you will receive a T5 slip listing the amount of interest your GIC earned, and it will be added to your income. As you can see here, the full amount that is reinvested into the GIC is added to your taxable income annually, even though you won't be able to access it until the 5-year term is up. This wraps up our video on the basics of GICs and how to properly structure a successful investment portfolio. If you have any questions, comment below to let us know, and if you like the video, give it a thumbs up so we can create more content just like it. Thank you so much for watching, and we'll see you back here on Thursday.